Welcome back to Market Movers, the opening bell. U.S. stock futures are pointing to a lower open with the S&P 500 as well as NASDAQ futures off by 1%. Now Wall Street stocks rose and the Dow hit an all-time closing high in the previous session. All three major U.S. stock indexes advanced, but weaker mega cap growth stocks capped the gains for the NASDAQ. Meanwhile, the Russell 2000 has rallied nearly 10% in 5 sessions for its best 5-day performance since June 2020, but it is up over 12% year to date. Well, joining me this morning is Tom Hayes, Chairman and Managing Member of Great Hill Capital. Tom, so great to have you here today.
Great to be with you, Remy.
Well, we are seeing stock futures pointing to a lower open, but as you mentioned, it is no surprise given the recent gains. So what's happening right now?
Well, I've spent the last two and a half weeks going around saying we're on the cusp of a sea change. We're on the cusp of a sea change. We're going to see this big rotation. Well, now we're in the sea change. And basically, what you had in the first 6 months of the year is you had 5 stocks account for 60% of the gains in the S&P 500. And the back half is going to be flipped on its head. It's going to be the exact opposite. I think we're going to see the general indices more subdued because the Magnificent 7 are going to underperform and the 493 are going to start to outperform in the last 6 months of the year. And we're seeing this. So this is volatility. This is people getting caught off sides, and I think we're going to see 2 key catalysts that drive that.
And speaking of catalysts, of course, we're all watching the Fed Reserve this year, and expectations for rate cuts heading into this year were very high, but now we're here in the middle of 2024 in the midst of a U.S. presidential election cycle, and we have yet to see a rate cut. So in terms of catalysts, what's on your radar?
Well, I think 2 things. Number one, we came into the year, everyone expected 7 rate cuts, and then it went down to like, we're never going to get a rate cut, and now we're back up to 95% probability of 1 cut in, actually 2 cuts by December, 98% chance of 1 cut by September. This is going to be a catalyst for that change, for the unmagnificent 493 outperforming in the last 6 months. That is a critical factor. The other thing to keep in mind is June was the first month that 0 global central banks actually hiked. And that was the first time that happened since October of 2020, March of 2009, and December of 2001. And what happened during those periods? Those were generational periods to buy cyclicals, dividend payers, small caps, everything that was out of favor. So I like to say the last shall be first. And if you're overweight and fully concentrated in market cap weighted indices or Magnificent 7 only, I think you're going to be less happy than you were in the first half. And if you're in those unloved stocks from the first half, you've already seen it. Like many of us have seen the last 7 days like they've never seen before in their careers. It's mind-boggling. And I think that's going to continue, and we'll have the normal fits and starts that you're seeing right now.
And Tom, for those of the viewing audience who are trying to understand this market rotation and the implications of a potential rate cut on certain sectors, why do you think we're seeing small caps as an attractive option right now?
Well, the second catalyst, in addition to the Fed, is earnings composition. So there was a reason that the Magnificent 7 outperformed. For instance, in Q1 of this year, the Magnificent 7 earnings growth was 50%, 50. The unmagnificent 493 was negative 1%. By Q4, that's going to change. The Magnificent 7 will have earnings growth decelerating to plus 17%. And the unmagnificent 7 will be about 19%. So that's why you're seeing the stocks are following the earnings trajectory. As far as small caps, we're only having 4% earnings growth in 2024, but expected to be 17% for small cap earnings growth in 2025. And the markets are now getting ahead of that, both in terms of earnings composition and in terms of cost of capital, with the Fed lowering rates, cyclicals, dividend payers, small caps, and international will start to outperform as well as the dollar weakens.
And Tom, it is earnings season, so we're keeping a close eye on results as well as guidance for a better indicator of what we can expect. But are there any names that you're paying close attention to right now?
Yeah, there are 2 that are interesting to us that haven't taken off yet. Everyone talks about the ones that are already up 100%. We could talk about those, but that's not going to help your audience. So let's talk about some that are, we believe, just getting started. Intel is very important to us, and Intel is the most hated semiconductor stock. You can't give the stock away, and trading around $33, $34. There's two reasons to like Intel. Number one, their legacy PC and server business, the boring CPU business, that's worth $45 to $50 a share. The stock's trading at 33, 34. But you get a free option. The U.S. government has given them $45 billion of grants, subsidies, and loans to stand up a foundry to compete with Taiwan Semiconductor over the next few years. So it's effectively going to be a duopoly. They are projected to be the largest AI foundry by 2030 and the second largest overall foundry. So while NVIDIA, Broadcom, Avago, they fight a war and they try to kill each other, Intel's going to be the arms dealer. And that's where you can make your money, and most people aren't seeing that yet, and that will become more and more apparent. But in the meantime, you have a margin of safety because of their legacy PC and server business. They're going to exceed 40 million AI PC refresh this year alone, and they're a key beneficiary of that.
Okay, Tom, well, thank you so much for joining me on this Wednesday morning, and thank you for weighing in on what's moving the markets right now.
My pleasure. Thanks, Remy.
Thank you.
Yeah.
And moving